Okay, Q&A Thursday. So we have a handful of questions today. Let's get into them. Question number one. I have a $375,000 Penn Mutual convertible term policy. I started it around September 2019. It was created to do IBC, but then I got laid off from my job. It was converted to a 10-year convertible term, and the monthly premiums are $55 per month. I got a preferred health status at that time and do not want to go through underwriting again, as I might not get that classification again. Can I convert this back to a whole life insurance policy? How does conversion from term to whole life work under Penn Mutual? So great question here. So just to kind of recap the situation, you had started a policy, it was whole life insurance, but ran into some financial hardships. So converted that whole life insurance policy to a 10-year convertible term life insurance policy. So the answer to your question is yes, as long as that policy is truly a convertible term, you do have the ability to convert that to whole life insurance fully or partially at any point in time during that 10-year time frame. Penn Mutual is fairly flexible when it comes to term conversions, meaning as long as the death benefit often does not exceed the original amount, $375,000, you'll be able to convert it to whole life insurance. Now, Penn and several companies sometimes have programs or periods of time where they will actually allow you to get a bit more coverage without underwriting. So that's always good to check with your agent or whoever you're working with at the time you are looking to convert the policy. So great question. The answer is yes, you can convert that back to whole life as long as it is done within the conversion window, and it can be for the full $375,000 or just a portion of it. Question number two, can I switch agents after I started a policy? So the answer is yes. You do have the ability to change your agent that services your life insurance policy, whether it is term or whole life insurance. Now, some agents will be very willing to do it. Others will not be. Why one would not be willing to take over the servicing rights is that most companies still assign or still pay commissions to the original agent who wrote the business, that brought them the business. So some agents can be reluctant to do that, and understandably so. Why would one take on a bunch of added work when there's no compensation? Now, how I view it on the flip side is, well, taking on that extra work and going that extra mile to help someone, it always works out, right? It can come back to you through referrals, excess business and such. Maybe the person purchases more, but it is good for all parties to be aware of that, in my opinion. Now, another part of this question is, or was, when I convert, or I should say, if I change agents with a term policy, can I then convert that term to whole life insurance? The answer is yes. And in a case like that, if you have a term policy and you switch agents to me, for example, and then convert it to whole life, that is a new whole life insurance policy, and the new servicing agent will be me in this case, which compensation would go to the new agent as well. So great question regarding switching agents. It is possible. Now I added a little bit of extra information there. Hope it was helpful. Question number three, what major mutual company offers the most flexibility for adding cash value with the OYT, that is the 1-year term rider? I prefer Mass Mutual, but am open to others that may offer more flexibility to add cash as I go. Great question. So when it comes to PUA flexibility, the OYT or 1-year term rider is a great option to be aware of to open up flexibility with a life insurance policy. Now, you had mentioned Mass Mutual. They are a great company, behemoth in terms of their size, and have had a solid dividend and, most importantly, solid historical performance over time. Now, with Mass Mutual, if we attach their 1-year term rider to a life insurance policy, how their flexibility works is you can adjust your payments one time per year without any underwriting, provided that payment fall on your policy anniversary date. That specifically exists with their 1-year term rider. So for example, year 1, I can pay in $10,000, year 2, $50,000, year 3, $30,000. See where I'm going? I can go up and down. Now, To follow up on your question, do other companies exist that have more flexibility? The answer would be yes, depending on how you view the situation and if you need or want that flexibility. For example, if you are looking at the major insurance companies, right, the 4 major mutuals, Guardian has a ton of flexibility, especially if one attaches their OYT, their 1-year term rider. Guardian is a company that will allow one to commit to the minimum base premium only and covering the cost of the OYT. So I pay the base premium, OYT charge, and then at my discretion, I can add PUAs on an unscheduled basis. This can be through a check, phone, or my online portal. Very, very flexible in that respect. The limitation is really up to my MEC limit. The most we can illustrate often is 10x the base premium in PUAs per year while that 1-year term rider is attached. That's with Guardian. Now, that's one of the major mutual companies. If you were to look at other companies, there's some smaller companies out there that are more flexible with 1-year term riders. An example may be Security Mutual, a very small company based out of New York. However, if we have a 1-year term rider attached, there's no limitation. You can go 40x the base premium in PUAs. Now, it's always good to assess different companies, but these are just tidbits of information we'd like to be aware of to always try and provide a thorough answer and not leave any chance for buyer's remorse, of course. At this point, as I mentioned many times, I still recommend the big 4 or 4 major mutual companies or any company that has a proven track record of actual performance. Last question, how soon can you take a loan from a life insurance policy with one of the major insurance carriers? Great question. So our experience is that typically you can request a loan from your policy anytime. Often the insurance company likes to see 10 days go by, 10 business days, to ensure that the funds have actually cleared our bank account and are legitimately with the insurance company. That is for their comfort level. That's in experience how quickly the turnaround time is, or I should say when I can request a loan from a life insurance policy. From the date I request it, if I go with direct deposit, typically it's around, call it 2 to 5 business days. They're usually pretty quick, between 2 and 3 business days. But after that initial wait period of 10 business days, I can request them anytime. As a quick side note, it is important to be aware of the contract language. You will see with most insurance companies, when you read the fine print, they do reserve the right to hold loans up to 6 months before they grant a loan request. Now, have I ever seen that happen? No. They want to make sure that everything's in good order, that things transact properly, that fraud is not trying to be committed. We actually ran into a case of that once where someone else was trying to request a loan that was not the policyholder. They pretended to be, but fortunately, we were able to find everything out beforehand. Point being, that is why a loan might be held up, because they want to make sure that everything is legitimate. But to answer the question, how long does it take before I can request a loan? Typically 10 business days and 2 to 5 business days from the date I request it. As always, I hope this helps. Reach out with any questions and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.